Hey everyone, welcome back to the channel. Google just reported earnings this week, and despite massive revenue growth, the stock has tanked 8% on the news. Let's jump in and break down the earnings and see if this is a rare buying opportunity. I'll be using my investment analysis website, investmenthorizon.io, to analyze these numbers. If you want to follow along, check it out for free. The link is in the description. Looking at their latest figures, Google delivered another strong quarter. Google's revenue for 2024 reached a staggering $350 billion, up 14% year over year. Switching to the quarterly numbers, Q4 revenue specifically hit $96.5 billion, a 12% jump on the same quarter in 2023. This growth was fueled by continued strength in search, YouTube, and particularly Google Cloud. Earnings also soared by 31% to $31 billion, driven by improved margins when compared to the same period last year. Drilling down into the performance of the individual segments, we can see that search revenue grew 12.5%, YouTube revenue increased 14%, Google Network revenue declined 3%, subscriptions like Google One rose 8%, and Google Cloud posted an impressive 30% growth. Surprisingly, despite these strong numbers, the market has reacted negatively with the stock price dropping 8% this week, which raises the question, why is the stock down? Well, Google has announced plans to spend $75 billion on capital expenditure this year, with a large portion of this spend going towards cloud and AI infrastructure, and that is what investors are worried about. $75 billion is a massive jump from $52 billion last year, with the recent announcements from DeepSeek indicating that AI models can be trained at a fraction of the cost. Investors are questioning whether this capital expenditure is warranted and what the return on investment is going to be. Additionally, high capital expenditure is going to impact valuation models, as more spending on capital expenditure lowers free cash flow, which is an important metric for stock valuation. Digging into Google's free cash flow, we can see that it has only grown by $4 billion to $73 billion, despite the company making a $24 billion increase in operating cash flow and a $33 billion increase in their earnings. This is primarily as a result of the massive capital expenditure, and we can see that this is reflected in the deviation between the earnings per share and the free cash flow per share. So is this really as big of an issue as it's being made out to be? Well, if we look at some of the other big players in cloud and AI, we can see that despite the DeepSeek announcement, Amazon will still be spending over $1 billion on CapEx. Meta plans to spend $60 to $65 billion, and Microsoft plans to spend $80 billion on infrastructure. So there's clearly demand and competition to capture market share across these key players. And I think overall it's going to come down to who can capture the demand and whether we are going to see a continuation of high returns from these investments. Now diving to some of these segment results, we can see that cloud is a major growth engine and Google's second largest revenue stream, even larger than YouTube ads. Google is currently the third largest player in cloud computing behind Microsoft and Amazon. Looking at the figures for this division, Q4 revenue soared 30% to $12 billion, with cloud growing significantly faster than the overall cloud market. To put that growth into perspective, Microsoft's Azure grew around 30% as well, and Amazon's AWS only grew 19%. So Google is showing incredible momentum that's comparable, if not better, than some of their competitors. So is this growth sustainable? Well, part of the large investment that Google is doing is to build additional infrastructure to keep up with demand and to build out AI integrations across their ecosystem, which will aid in the growing of the segment over the next few years and help sustain this level of growth. Diving into YouTube, YouTube remains the undisputed king of online video. In Q4, YouTube ads generated a staggering $10.4 billion. To put that into perspective, that's more than Netflix's total revenue of $10.2 billion for the quarter. Additionally, YouTube has several tailwinds, which are expected to continue to drive growth. Firstly, YouTube is continuing to grow its watch time on their longer form content. Secondly, shorts are rapidly monetizing and contributing a larger portion towards total revenue, whilst expanding YouTube's audience to a younger demographic. And finally, YouTube's new AI video generation tool, VO2, is coming soon to creators, which should drive the generation of more content on YouTube in the long run. On the earnings call, CEO Sundar Pichai emphasized Google's full-stack AI advantage, highlighting not just their AI models, but also the massive infrastructure investments behind them. This includes new data centers, subsea cables, and continuous hardware advancements to support their new AI expansion. One of the biggest developments is Gemini 2.0, which is now powering AI overviews in search, improving user engagement, and handling more complex queries. Circle to Search is also gaining traction, potentially driving higher ad revenue as it becomes more widely adopted. Pichai also teased upcoming AI breakthroughs like deep research for advanced information retrieval, VO2 for AI-generated video content, and Imagen 3 for cutting-edge text-to-image generation. On the developer side, Gemini 2.0 Flash is now widely available, with even more sophisticated thinking models in the pipeline. His message was clear: AI is being integrated into every Google product, making them stickier, more valuable to users, and ultimately strengthening Google's competitive position in search, cloud, and beyond. So is Google stock a buy after this drop? Here's my take. The company remains a dominant force in search, video entertainment, and cloud computing. Revenue and profits continue to grow at double-digit rates, and they're growing their margins and growing their returns on capital. All this shows that the company is able to reinvest profits back into the business and drive strong growth, which ultimately is going to increase the value of the underlying business and should drive up the price of the company over the long term. Overall, I think the aggressive CapEx strategy is a long-term positive, but creates near-term cash flow concerns, which has driven down the share price. But ultimately, this recent pullback in price makes the stock more attractive. If the stock drops even further, it could offer a great opportunity to buy more shares in Google. So there you have it. Google's Q4 2024 earnings reveal a company doubling down on its AI and infrastructure, even at the cost of short-term cash flows. While some investors are concerned about the aggressive CapEx, the long-term growth potential in search, cloud, and AI-driven services remains incredibly strong. This recent pullback could be a great buying opportunity for investors who believe in Google's AI-powered future. What do you think? Are you buying Google at these levels, or do you think this AI bet is too risky? Drop a comment below, and if you found this breakdown useful, hit that like button and subscribe for more deep dives. I'll see you in the next video.